Hello everyone and welcome back to High Finance Graduate. In this video, I am going to be answering one of the most requested questions that I keep on getting nowadays, and that is, make a video about hedge funds. Tell us about hedge funds. Why don't you make a video about hedge funds? Okay, so here it is. In this video, I'm going to be talking about the reality of hedge fund. What is a hedge fund? Who uses hedge funds? The good side and the bad side of hedge funds. Okay, so let's begin. Now, the first thing that we have to talk about is the definition of a hedge fund, because this is going to surprise most of you, and it's not exactly what most people think about a hedge fund. Hedge funds uses leverage and complex financial strategies and financial instruments in order to provide uncorrelated market returns. Now, let me just break that down. In simple terms, a hedge fund is designed to give you a hedge against any downside. So, in simple terms, what that means is it's just to protect your money. It's not necessarily to grow your money. You don't invest in a hedge fund in order to make billions. You invest in a hedge fund in order to get protection from any downturn in the market. If a hedge fund manager invests $1 million in an ice cream truck, now when it's sunny outside, everyone's out, everyone wants an ice cream, and that's great. But what happens when it's raining? If it's raining, well, no one is going to want to buy an ice cream. No one's going to want to queue for ages in order to get an ice cream because they're going to get wet. So the hedge fund manager is also going to invest $1 million in an umbrella company. So what this means is when it's sunny outside, the ice cream truck is making money. But when it's raining, the umbrella company is making money. So essentially, regardless of the weather, if it's sunny or if it's raining, the portfolio is always making money because one of the investments is always paying off, and that's hedging. Why does hedging matter so much? The reality is, as the world becomes more globalized, financial markets become increasingly synchronized with one another. You often find that major companies, blue chip companies, will move in the same direction as indices. So for example, in the US, if the S&P 500 or if the NASDAQ is up for the day, you're going to find that major companies like Microsoft, Berkshire Hathaway, Netflix, Alphabet, they're also going to be up. Likewise, if the market goes down, those companies are also going to go down. And it doesn't just stop there. This also leaks into other markets. This is then going to have a knock-on effect into the European market, into the Asian market, and even sometimes even in the emerging markets. So it's really difficult to find downside protection. It's really difficult to find your umbrella to your ice cream truck because all the markets are now correlated. So you can see why it's becoming increasingly difficult to find downside protection, because if all the markets, if all the companies are becoming synchronized to that market, then regardless of what companies you invest in, they're all going to go up and down with the market. So if the market is undergoing a correction, or if the market crashes, if something happens to the market, at least you are protected because the hedge fund is designed to hedge against the downside, either by using options or by shorting specific sectors. However they're going to do it, however they're going to design their portfolio strategy, that's what they're supposed to do. Now, as a consequence of this, the cost is that you're not going to get all of the upside, but at least you get insurance from the downside. So there's a real need to find uncorrelated market returns. So essentially, hedge funds came in order to solve this problem by creating a portfolio of stocks and bonds or whatever assets they invest in, whatever strategies which they use in order to protect their investors from the market. So regardless if the market is going up or down, the client's portfolio, the investor's portfolio is steadily going up. Now, a common misconception about hedge funds is it's a sure way of beating the market. No. And I pretty much blame Hollywood for this, movies, books even, and TV series like Billions for glamorizing the world of hedge funds into making it more than what it actually is. Now, there are some hedge funds which consistently perform really well. For example, you have Renaissance Capital, or you have a Bridgewater Associates, which is run by Ray Dalio, and they have a significant track record of beating the market. And those are exceptions. Now, there are always exceptions, but the norm, the average of the hedge fund performance doesn't beat the market. Again, because a hedge fund is not designed to beat the market. They are designed to protect investors from the downside. They are designed to give investors uncorrelated returns from the market. What separates hedge funds from other funds out there, like a pension fund, an endowment fund, or any regular fund that you find out there, is pretty much two things. Number one is the variety of investment strategies which hedge funds uses and deploy in order to make a return. And some of these strategies, again, the main reason why these strategies exist is to provide uncorrelated market return. And some of these strategies will include credit arbitrage, merger arbitrage, risk neutral, relative value, long-short equity, and there are a lot of investment strategies. Again, take a look at the video where I talk about the investment strategies which you find at leading hedge funds. But what's also interesting about hedge funds is the venue which they can trade in. So not only do they use financial instruments such as futures, swaps, derivatives, options, they can use various types of financial instruments, but they can also trade on different venues. So for example, they can trade in the dark pool, they can trade on private markets, they can trade non-conventional markets as well. So it's really specialized, and it takes a high level of sophistication in order to operate in the hedge fund world. Now let's answer a very contentious question. Are hedge funds good or are they bad? Now, this is something which is highly contested because you can make the argument for both sides, they're good and bad. But what might surprise you is one of the harshest critics of hedge funds is actually Warren Buffett. Not only is he a critic, a verbal critic, but he also took it a step further. He made a bet with a hedge fund manager that in a span of 10 years, net of fees, hedge funds will return less to investors than had the same investors invest their money in the market. So the point of this bet was to highlight the fact that the average hedge fund doesn't actually beat the market. And I think Warren Buffett proved just that. And guess who won the bet? Warren Buffett won the bet. Now, some hedge fund managers will argue that, okay, the role and the main goal of a hedge fund isn't to beat the market, but it's to provide a hedge against the downside. Valid. Second argument is the rate of return varies significantly from strategies to sectors in terms of the hedge fund world, because the bet was the average return of hedge funds. And in the same time period, you have Bridgewater Associates. They consistently beat the market every single year. So had they invested in Bridgewater, then they would have made a lot more money than had they invested in the market. So regardless of which side you're on, whether hedge funds are good, whether they're bad, whether they fulfill their purpose or not, that's completely up to you. So now let me break down the pros and cons of investing in a hedge fund. I think the best way to make up your mind is by going over the potential benefits of investing in a hedge fund versus the benefits of investing in a regular fund. So the benefits of investing in a hedge fund. Number one, risk-adjusted returns. Now, if you were to invest in the market or a regular fund, then you'll be investing passively. But whereas if you're investing in a hedge fund, it's active management. You have some of the smartest people working in a hedge fund actively buying and selling stocks in order to generate a return. On average, they do make some return. So you are getting not only downside protection, but you are also getting some kind of return as well. Number two, you're getting uncorrelated returns. Depending on the strategy which the hedge fund is using, typically speaking, hedge funds, they provide uncorrelated return from the market. So if you're in a period of a recession, if you're in a market crash, if there's a pandemic going on, if there's a correction in the market, regardless of what's happening in the market, regardless of what your friends are talking about, regardless of how their money is doing, at least you're being protected because you're in a hedge fund which is designed to protect against that. Number three, they give you downside protection. And I think that's a really important aspect to highlight, because if you're a pension fund, if you're an insurance company and you have really long-term liabilities, the worst thing that you want is to lose money by investing in the market. So you always want some kind of guarantee protection. You want to cap your upside as long as you get downside protection. So if you are a risk adverse investor, if you do want to protect your money as opposed of just chasing growth, then finding uncorrelated market returns is very important. So those are the main 3 benefits that I can see by investing in a hedge fund. So now let's take a look at the 3 main benefits of investing in a regular fund. Number 1 is it's much more economical. By investing in a regular fund, they're just going to charge you 2% of AUM. Now 2% of AUM is pretty much, the fund is just going to take 2% of whatever money you have invested, regardless of how the fund performs. Whereas if you were to invest in a hedge fund, their typical fee structure is 220. What that means is they take 2% fee of the AUM. So again, whatever you invest in the fund, regardless of how it performs, whether it made a profit or not, they're going to take 2% as their management fee. But then if they do beat the market, however you're going to measure it, by beating the S&P or by beating a specific benchmark, they're going to take a 20% performance fee as well. So you're paying a lot more by investing in a hedge fund, whereas you're paying to invest in a regular fund. Second, by investing in a regular fund, typically they're going to be investing in blue chip companies, in high quality stocks. But that's not the same for hedge funds. Some hedge funds, depending on the strategy which they're following, they could be investing in real estate, which takes a long time to unwind and for you to get your money back. Or they could be investing in really strange strategies, whether it's financing a litigation lawsuit, whether it's investing in yachts or boats or wine or paintings. And again, there are various strategies in the hedge fund world. Take a look at the video to learn more about those. But it's not easy for you to redeem your money in the hedge fund world, again, depending on the strategy which they're following. And because of that, some people prefer to have easy access to their cash, so they invest in a regular fund. Number 3, it's a lot easier to invest in a regular fund than it is to invest in a hedge fund. If you want to invest in a hedge fund, there are some criteria which you have to abide by, and this is because of government regulation, because of KYC, which is financial crimes, that you have to be a sophisticated investor. You need to know what you're getting yourself into. And some hedge funds will require you to have a certain level of net worth before they even accept you. But on the other hand, at a regular fund, you can pretty much just buy units, you can pretty much just invest money without having to jump through a lot of hoops. It's a lot easier for you to invest in, and pretty much anyone can invest in a regular fund. Okay, so I hope you have a better understanding of what hedge funds are in the real world, what their aim is, and what are some of the benefits of investing in a hedge fund versus a regular fund. I am going to make follow-up videos to this. Again, take a look at my videos on the 20 investment strategies which you'll find at hedge funds. I'll be making videos on how to ace the hedge fund interview process, as well as other videos in the hedge fund and asset management space as well. But if you are interested in breaking into asset management or hedge funds, then take a look at the interview and recruitment guide, which pretty much breaks down the whole industry, talking about the specific strategies, the specific fund you should target depending on your personality, what you are going to be doing on a day-to-day basis from the kind of research. And pretty much we're going to go through the whole interview process, from learning how to pitch a stock to answering technical questions and behavioral questions. So don't forget to check that out, and I'll leave a link in the description below. And as usual, I will see you in our next video.